I think the spring market is strictly for investor. I don't think we're going to have a spring market home buying environment other than in the suburb markets and very specific communities.
This is the Basu Lifestyle Show, the show about learning what it takes to build a superior you, mentally, physically, and financially. Be sure to like the video and subscribe to the channel. And also check out BasuLifestyle.com to purchase merchandise to support the Basu Lifestyle. Today I'm going to be joined by Joe Scorsese. Joe Scorsese is a nationwide private money lender. He also has a podcast called the Creative Burr Strategies Podcast, and he's also an investor himself. So Joe, thanks for sharing your time with us. Can you give a little intro about yourself and what you do?
Thank you, Steve. My name is Joseph Scorsese. I'm Senior Loan Advisor at Landmark Capital. We're a nationwide direct private lender. We provide asset-based lending options to investors strictly, non-owner occupied in the name of the LLC, S Corp or C Corp. We look at 30-year fixed money up to 80% on purchase or refinance DSCR, fixed to rent, fixed to flip, up to 90% on purchase and 100% on construction. We look at new construction. We can look at multifamily 5 through 25 units. We also will look at a blend of mixed use and residential, as long as the blend of the commercial is less than 30%. And then we provide construction lines of credit and unsecured business lines of credit for real estate investors. I'm also a CE instructor at Temple University as an adjunct. I also teach CE nationally in every state in the country on navigating asset-based lending. Licensed realtor, investor owner the last 36 years, licensed banker for the last 24 strictly in the asset-based lending space the last 6.
Okay, and you're also an investor. How long have you been investing yourself?
Since 94.
Okay, so you're well-rounded. If somebody has a deal that they kind of aren't sure of, they could come to you and talk about the deal, the numbers, and obviously come to you for the financing for it.
I've made plenty of failures and plenty of successes. I consider myself very transactional in a good way.
Okay, what's kind of the difference between getting a loan from a bank and using someone like you who's a private lender?
So a bank is traditional. They're going to look for tax returns, W-2s, 1099s, pay stubs. We look at the actual physical asset that you're looking at, whether it's for creating future value or enhanced value on a renovation. And also traditional lenders don't do fixed to rent, fixed to flip. We look at the asset itself. We look at the potential purchase price, what the repair costs are, what the after repair value is. We look at your credit score, which our credit score requirements are 660 or better, where a bank or traditional lender really looks at 680 or better. But again, you really want to have 680 or better anyway. We look at your bank statement, make sure you have the proper reserves. We also ask you a little bit about your experience. How many, investment properties you've purchased in the last 48 months or own currently? How many rehabs have you completed for rental in the last 48 months? And how many flips you've completed in the last 48 months? And if it's new construction, we ask about, how many new construction builds have you completed with ownership in the last 48 months? Now, you have to be able to verify ownership. You can't just say, I walked by a rehab and I actually own that property. It's that we're going to verify those answers because that justifies our rate and justifies our leverage. Our timelines to close are much different than a traditional lender. We literally can close a refinance or purchase DSCR within 25 to 30 days because a lesser of the documentation. And a rehab fixed to rent, fixed to flip, the average close time is 15 to 20 days.
Okay. And you said that you're basically at 80% loan to value.
We could, depending on the DSCR of the property, your credit
Okay.
score, and the asset type, yes.
Okay. So can you explain a little bit if somebody's looking at investment property, what that kind of means? So how much they'd be putting down, just like a basic, say 4-unit, if they were looking at it, just trying to understand a little deeper because they don't really know any of the terms, kind of DSCR, and I need to put how much down.
I know the term has been it's very new in the for the actual investor. It's been around forever, DSCR. So, but the way that asset-based lenders look at it, they want to see, are you making 1.0 times more money than the current debt on the property, meaning the principal, interest, taxes, and insurance, and if there's association fees if it's a townhome or condo. So we like to be 1.0 or better. We can actually go as low as 0.80, but again, it's all going to be depending on the credit score, the asset type, and really, what's the game plan to that property? So the safe place is to make 1.2 times or better of your PITI. 1.2 debt service coverage ratio is typically the standard, but there has become more flexibility because say somebody can't sell a home and they ate away at the profitability or equity of the property, they might have to go down to 1.0 to make that deal work. And again, the rates are going to be maybe a little higher, but it's the cost of doing business, and you get to not get foreclosed upon because you
which
couldn't
is
sell the
good.
property, you had to rent it.
Yeah, no, absolutely. What are you seeing with rates right now? Because they're kind of jumping around, and then you have a lot of tension around the world, which is kind of making them stay high. It seems like also.
hmm So, the traditional lender has volatility every day. A commercial lender, such as myself, we were at 6.75 base rate. That's where our rates started uh, for quite a while, and we just recently moved it up a quarter point. So our base rate on DSCR, to refinance or purchase a standard turnkey property, starts at 7%. And irony enough, you're not maybe not old enough to remember this, but the last 40 years, the average rate has been 7%. It's an industry number. The anomaly that happened, 3, 4 years ago at 2.75 was an anomaly. We don't want to see that happen again because the banks would basically all shut down. Okay, you really don't want to have that. I mean, listen, you're going to see between 7 and 10% over the next 24 to 36 months as we cleanse what's going on with office retail conversions, inflation, cost of living, migration reports. So right now rates are falling somewhere between 7 and 7.5 right now on refinance. On the construction money, that really hasn't really been impacted because it's already an accelerated interest cost. Our base rate on construction money starts at 9.75 plus maybe a $2,500 origination fee or 1.5 points, depending on what the loan size is. Because we're a direct lender, it's our money to disperse. So we're not really charging heavy costs to close the loan. That's where the brokers start tacking on their money. But we're probably at 9.75. The rates are probably coming in around 10 and a quarter, 10.5, depending on how many rehabs completed or how many rehabs you haven't done yet. So if you're at zero, your rates are going to probably be between around 11, 11 and a half, maybe 12. But, you got to get a couple deals done. If you're making a lot of money on the back end by putting 45, 50 grand into a property that you're buying for 100, it's going to be worth 200 at the back end. You know what? Get a couple of those done, get the experience, and then you'll start seeing better rates on that construction money as time progresses.
Okay, and you're saying moving forward, rates should stay somewhere around here as long as nothing happens within the economy. Obviously, the only way rates are really going to come down is if we hit another war or the economy basically crashes. If not, rates stay the same for more or
We're
less.
already in three wars.
Well, exactly. I mean, it's crazy because the economy, like everybody's saying it's okay, but I feel like the average consumer is getting kind of hit from every angle.
Oh
Where
yeah,
where do
I
you
mean
kind
there's
of
a lot of
see the
distractions.
economy at?
I mean, the economy is not as strong. I mean, you have a lot of volatility. You have a lot of concern. There's layoffs and unemployment issues, and you have a massive illegal immigration coming into the country that's really flooding the market centers such as Philadelphia, Chicago, St. Louis, all the major cities. And the governments there are just not really performing a good balancing act between, the community itself and this illegal immigration movement. So what's happening is the cost of everything, crime stats, everything's kind of thrown all over the place, and people are mass exiting out of the urban settings, going into the suburban or rural settings, and protecting themselves from all that. And what's going to happen in these urban settings, you're going to see massive changes to a rental environment in all those cities. All of them are going to be impacted, where people are not going to look at a home ownership. Hey, I want to move into the city to own a home. No, the only reason I'm moving into the city is because I'm going to rent, because it's going to become more cost effective. I think affordable housing will be more appealing in the inner cities and less appealing in the suburban and rural markets over the next 10 years.
Yeah, I think that kind of started happening around COVID too. Everybody kind of was like, you know what? I'd rather be in the suburbs than living in the city where I'm trapped inside. In the suburbs, I can go
Yeah,
for walks, I can hit the trails, I can have a pool, a yard,
that's
all
what
of
we
those
did.
things.
We did that 3 times a day, 5 miles every time.
Exactly. Yeah, I think that was like the mass exodus from the cities because before that, it was like everybody wanted that urban vibe to move into the
Yeah, we're going
city.
back in.
Now, the other thing that happened during COVID was it seemed like everybody started talking about real estate. It was everything real estate. You have to be buying real estate, which is a good thing, yes, but you have to kind of know the numbers and do your research. It's not like you just make money because you bought real estate.
You make
Would
money
you
when you
agree
buy
that
it.
like a lot of people jumped in around COVID and it kind of seemed like you just buy a house and it goes up? Like you make your money on the buy, correct? Is that
Yeah,
kind of how you
of
see it?
course. That's how I look at it. It's always been that the case. So, you know, you still have to. There's three important numbers when you're evaluating a deal, whether it's single family, 2 through 4, 5 through 25, or 25 units and above. What's the stabilized value of the after repair value? What is your repair cost to create that value add, and what are you buying it at? And do those numbers work? And do they work for you as well?
Yeah. I think too, a lot of people just thought they were going to buy because since 2020, if you bought, it just went up, especially if you bought single family. If you bought, say, 2 units, you bought anything in 2020, the market went up. You're a genius. You sold, you flipped. And you really actually have to know the numbers a little deeper.
I typically provide worksheets for any
Yep.
investors, whether new or experienced. One's on the Mayo sheet to understand the maximum allowable offer, how to buy a property. One's on cash flow, to cash on cash return. One is a DSCR worksheet. Then the other is a rehab construction budget. And then one is also a data tape where I understand your background of experience and or ownership in real estate. So I
Hmm.
typically send that out to any of my clients just to have to pencil deals down. But that deal you're buying too high based on your current numbers.
Yeah, you don't like them. Okay. So where are you seeing opportunities within the market right now?
Are we talking like nationally or
No,
regionally
we'll
or
stay.
locally?
We're both kind of, let's say New Jersey, Philly. Just we'll say in that area, New Jersey, Pennsylvania, because I know you're national, but at the same time, that's a little more local because you're within the same vicinity.
Yeah. So locally, I really do like that corridor of Cumberland, Atlantic, and Salem County. I think there's really strong management presence down there. There's good bones in the properties where they can be rehabilitated, and people are just not thinking about that area. They're like, oh, they're thinking that from 20 years ago. It's just a different market down there. I do like the surrounding areas of Philadelphia. Obviously, Delaware County, Montgomery County, very, very congested with investors right now, as well as Chester County and Bucks. I would look in Delaware, the state of Delaware. I like that market because the tax base is different. It's lighter. DSCR works much better. Um, so again, it really depends on what money you have set up for yourself, what your credit score is. Do you have the LLC set up? But I like those markets specifically. If you're going to go into Philadelphia, you need to understand Section 8 housing as well as Camden or Trenton, because your market rent in those cities is Section 8. It's not market rent. You don't want to rent to somebody that's not Section 8. That's a professional tenant, and you could run into some serious problems when it comes to eviction. With the Section 8, you got the voucher, you know what you're getting 80, 90 cents on the dollar, 100 cents on the dollar. You could basically forecast your DSCR for the next year and go year to year based on increases.
How do you look into Section 8 if you didn't know anything about it, if you were looking into it from the landlord perspective?
Well, I mean, I first would do some searching online, some Google searching of courses that are available. Usually, these cities offer training to understand. I know Philadelphia has a training course in becoming certified in Section 8, but identify property management companies, vet them to find out who's actually doing Section 8 property management, and surround yourself with those professionals because those are going to be your front line. You don't want to take the phone call at 10 o'clock at night. I mean, you're not going to go down there and handle a plumbing issue or a heating issue. Your property management's going to facilitate that. They understand Section 8. They understand response time. They understand the maintenance of a Section 8 and the turnover of a unit to make sure it qualifies for Section 8. So you want to surround yourself with that team in those type of city settings because that's your market over the next 3 to 5 years.
So you need to dig in more into that before you just say, I'm just going to get a property in within this city and do Section 8. You kind of have to
Yeah,
know you got to
you
have a
don't
team.
want to do that. You'll get buried. You'll be buried.
Because, like you said, they are kind of professional. A lot of the renters kind of know the system, know what they can get away with. And One of the things I kind of realized too is if they're renting and they have nothing to lose, you're not going to go after them. It doesn't matter how many times you file evictions, this, that, and the other. What difference does it make? You can't get money
No,
out of
it
a
does.
stone or blood out of a
It
stone,
doesn't.
however that saying
It
goes.
doesn't. When I was in a single family through four family space, I really enjoyed the Section 8. I understood what had to be done, and I stayed on top of it because they guaranteed my check on the 5th of the month on all my tenants. I loved it.
You just have to know what you're doing.
Exactly.
Do you think there's going to be any opportunity in single family, or do you think it's going to be in multi-unit properties?
Listen, there's always an opportunity somewhere. I mean, I could drive down the block from my house and I could see three blighted houses I would want to identify in a single family space, whether to rehab to flip or rehab to hold, because your rental market in the suburbs is very strong. So somebody that's a home buyer can't afford to buy a property that needs a lot of rehab because they're barely been able to get into the project itself as is. So to an investor, that's opportunity. I personally think we're in a strong investor market buying environment right now. I think your home ownership is only out of necessity and it's waning. I think the spring market is strictly for investor. I don't think we're gonna have a spring market home buying environment other than in the suburb markets and very specific communities in the suburbs of a lot of the major cities throughout the country. I mean, I would follow migration reports that are provided by Buildium, Penske, U-Haul, United Van Lines, and see where that renter migration is going. The out-of-state landlords becoming much more popular than just staying local, but there's still plenty of local opportunities within 20 minutes of where you live.
Yeah, I think what's it called? Driving for dollars. So you drive around, write down the addresses, and then send them letters, knock on the door, do whatever it takes.
Hell, put a for sale by owner sign on their lawn and put your phone number in there. You'll get a phone call. I can tell you that.
Do you think that a lot of people who bought up single family are going to end up like bought them to be to rent out? Do you think that they're going to end up selling? Because I feel like some people bought at like the height of the market, and I didn't see how they had any room for cash flow.
Well, it depends. I mean, you still have a steady appreciation on a lot of these properties.
Hmm.
Rents are still stabilizing and still pointing up, though. They're level in some areas and moving up in others. Then you have the concern of the influx of rental stock coming online from all these conversions from office retail to residential. Also, you have major announcements going on with malls that are chopping up these malls and adding 1,100, 1,200, 1,400 rental units to that immediate market. How will that impact the inventory for renter demand? Um, there probably is going to be a very serious balance there because again, home ownership is waning. The younger market is looking to rent, not own. The younger investor is looking to rent and own investment properties. That's also happening as well.
Yeah, and I think rents are either going to stabilize or kind of go down a bit, right? I mean, rents kind of jumped very high over the past 3 years. Do you
It
think
did
it
spike.
stays? Do you think it stays? Do you think it goes down a little bit? Where do you kind of see it?
I feel it's going to level off and maybe even decrease in certain areas because of the influx of development of, everybody, anything that's being built right now is being built to rent. We just had a podcast on my podcast at Creative Bird Strategies, and we discussed about build to rent and how that's going to impact, the rental market. And I think it's going to impact it where if you have a million more rentals put onto the market over the next year, and you're already having a 3-month vacancy on one of your properties, you're going to have to cut back that rental amount, right?
Yeah, no, absolutely. And it looked like just in one of the towns that I have a rental in, the rent went from like 1,400 to almost 2,200 just from 2020 to 2024. And it just people have been paying it, but at some point, number one, people's income didn't go up enough to cover that.
There's a
So
capacity.
something's gonna give somewhere. It has to.
Absolutely. I agree with you. And that's where, like, if you're going to go in a suburban market or rural market to rent comparatively to an urban market, you have to understand your demographics, the transportation conveniences, job reports. I'm seeing some good markets that are going to have really good job numbers in the next 3 to 5 years. I'm seeing landlords migrating to other markets because they can't make it work here. So they're looking for better debt service opportunities elsewhere.
Yes, you have to follow more or less where the deals are going to be, not just buy within a certain area and hope for appreciation.
Yeah, you
So
can't throw crap up on the wall and hope it sticks.
what are some resources that people can use to kind of learn more about, real estate investing, get like a better deep understanding of everything so that they're making good offers?
Well, I used to just say the RIAs made a lot of sense, but there's so many now investor group meetings where there's true masterminding being conducted, where you could identify individuals to be in your power team, and I mean, like it's funny, like I'll just use New Jersey. There's like 25 different events to go to. Connecticut, there's 12 different events to go to. Massachusetts, there's like 30. It's not all RIAs. They're all investor groups and different type of concepts. Just be cautious of the risk of being sold a package, like a workshop. Those I'd say, beware, because when there's economic concerns, it seems like the sell-a-thons come back. They're suddenly out of retirement to sell more crap. And all you're going to end up doing is shelving that shit. Okay. Go to true meetings where there's anywhere from, no more than 100 people in a room, but really that 25 to 50, and there's a real subject to be discussed. It's a slice of education. Like the same with the podcast that I offer. It's a different subject every Saturday and Sunday, but it's another slice to the pie of the overall real estate concept. So you're going to walk away with a nugget. Those more masterminding opportunities, less the sell-a-thon because of the economic concerns. You're not in desperation. If you're in desperation, real estate's not where you want to be. Real estate is a slow drip opportunity for you to build wealth over time. It doesn't happen overnight. So if you're looking for the overnight sensational workshops that are out there, good luck, because all you're doing is giving money to somebody else and you're not making anything.
Yeah, if it's a big name celebrity doing it, you're probably not going to get like local info and meet people. It's
Yeah.
kind of like a sales pitch
Well,
or something.
just even the local sell-a-thon people, you know who they are. You can tell who they are when they do their legends in their own mind, whether on Facebook or LinkedIn or some of the other social media buckets.
So tell everybody a little more about your podcast. So it's Saturdays and Sundays and how they can listen to it and how they can get involved.
So it started well, let's go COVID, right? We just bought a whole crap load of video equipment because we were going to start podcasting the events. Then suddenly everything shut down, and we decided to start doing a lot of podcasting. We did a bunch, 500 videos during COVID. It was crazy because there was nothing else to do other than work and do video and retain business. So from there, we then identified Clubhouse as more of an online service, and I know we were getting comfortable with it and going seeing how other operators were working their rooms, and a lot of them were unethical or not very integrous. So we created our own group called the Creative Birth Strategies. I'm sure we upset a few people, and I'm good at that. And we provided a consistent theme of education several times a week. Some people were vetted and had to go, and some people stayed. And we've turned over people because their true colors come out and their intentions. And we've rolled it out to a website, creativebirthstrategies.com. We've rolled it out to a podcast. We've rolled it out to an educational worksheets where it's complimentary. We send them to you to learn how to underwrite your deals. We'll set up a strategy discussion with you. There's no money being transferred to one another at all. It's really true strategy discussion. And then we now offer a CE accredited course on navigating asset-based lending for real estate agents in every state in the country. So we
Okay.
offer a 3 credit CE course. We're the only facilitation of a online audio video group that allows to send out a professional to teach these courses. And we also have national events with a national publication called Realty 411. We've had events in LA, Denver, Dallas, Fort Lauderdale, Philadelphia, and New York. We plan on having a few more next year or in the fall as well. So we're very unique because it's professional licensed services. So our incentive is to hopefully get some business from it, but we're not charging anything for any of this.
You give away enough stuff for free, people are going to come to you because they trust you. They know you, like you, trust you.
Well, you would hope.
What where do you find out about the CE course? Where's your
I can,
information at?
basically, I actually wrote the module.
Okay.
I got it approved by NAR, and
Hmm.
now it's being approved by state. I could send you the details to it,
Yeah.
the module itself, plus the write up and how to contact me to be able to offer that. My company will pay for me to come to the location and teach the course. And no, I will not provide food. That's for somebody that wants to sponsor it. God bless them. I teach the class for free. If you want me to bring food, now I'm charging $200 an hour for my time.
Do
So
you
I
do
come
that
and teach
class
the class.
online or no? Like at
No, it's
certain
only
times?
live.
Okay.
It's only
Okay. You
live.
only do it live.
I don't like the Zoom. I load all the CE for the realtor, but I'm not providing any food, no beverage, nothing. I'm teaching the course and then I leave. And I provide you all the insight. You have my cards. If you wanted somebody to bring food or beverage, that is your local sponsors. And we go from there. And we could do that
Okay.
for investor groups, associations, um, masterminds, whatever we need to do.
Okay. Then the worksheets. How can people get the worksheets that you were talking about for breaking down deals?
Same way, they could reach out to me via
Okay.
email or text and send me their full name and their email and their phone number. I'll send everything to them,
Okay. I'll be sure
and
to add.
hopefully, and if they need a strategy discussion, we could have that as well.
Okay. I'll be sure to add your details into the description so that people can reach out.
Thank you.
All right. Thank you for your time, Joe.